everyone. We made it to another Wednesday. Hope you guys are doing well. Thanks for joining. I'm Joe Pareca, and today we're talking more real estate. So we've got a great article for you guys. A little bit of a different flow today. So we're going to go over an article, and we're going to be talking about how this apparently, according to this Business Insider article, this lady is the bubble spotter, the housing bubble spotter. I don't know exactly what that means. If you know what it means, let me know. Hey, David, how's it going, buddy? Hope you're doing well. Thanks for hanging out on the stream. So we're going to be talking about this lady who's apparently the bubble spotter when it comes to real estate. She came out with 8 charts. They don't really have anything to do with a housing bubble, but they're really interesting charts. And they kind of talk about maybe where the market might go in 2025. And then after that, we have a short little video from the same person. And then for the second part of the stream, assuming we have some time, what I am going to do is I thought we'd switch it up a little bit and have a little bit more fun. The segment I did when we did overpriced turkeys went over really, really well when we cruised kind of the Zillow and Redfin and looked at all these kind of crazy properties that were stupid overpriced. We're not going to do another OPT segment, but what we are going to do is I'm going to show you guys how I evaluate properties as a professional real estate agent when I see listings online. So we're going to do some window shopping. And I'm going to have you guys pick a market, or we'll randomly pick a market. We're going to go to Zillow, and then I'm going to show you guys how I figure out what properties might be worth pursuing just based on the photos, the information, the listing, what we can see from Google Earth, all of those things. Thought that might be fun, might be helpful, and a little bit more interactive. So what we're going to do is we're going to start off by taking a look at this article, which is going to be up on your screen right now. It's from Business Insider. And this one, the title of this one, these 8 charts show what bubble spotter Ivy Zelman thinks will happen in the U.S. real estate market after the least affordable year since 1984. And you guys might have heard me talk about this comparison before. I have a full video on this subject on my channel where I compare the housing market at this time. I think it was in late 23 or early 24. I don't even remember, where we were comparing the market that we've been experiencing, not to 2007 or 2008 or 2009, but actually closer to the market of the early to mid 80s, which is interesting that it's brought up here. Personally, my thoughts are that this market is much, much closer to the market that we saw in the 80s with tough affordability, high interest rates, inflation, and home prices escalating. I still don't think that we're anywhere remotely close to 2008. If there is anybody that thinks we're still trending in the 2008 direction, that narrative has been going on for about 4.5 years, and it still hasn't hit yet. So I think we can officially move on from that nonsense that there's going to be this 30, 40, 50% price drop. Now, in some areas, there potentially could be, right? In some areas, we could see these big price drops. I just read an article. It was just a headline. I didn't have time to go into the article, but one of the headlines mentioned that Austin has seen a 50% price drop. Now, is that a crash? Yeah, kind of. There's a lot of factors that go into it, and it's not just price drops that that make something a real estate crash. But the moral of the story is that's just one city in one state in one country. Now, Austin is obviously it's the capital of Texas. It's a big city. It's a well-known city. But also Austin was one of those cities that was what we called a pandemic boom town. It was probably the biggest pandemic boom town, and it was the earliest pandemic boom town. So I'm not super surprised that now 3-4 years after the pandemic, after these unicorn years of 2020, 21, and 2022, that things have changed a little bit. So let's get into this article from Business Insider, and let's see what these 8 charts are, what they say, and potentially what they could mean for you guys that are looking to potentially buy and sell. And before we get into this, if you guys like the stream, help me out. If you haven't subscribed to the channel, please hit the subscribe button. It's free, doesn't cost anything, helps out my channel. And if you're enjoying the stream, please go ahead, hit that like, hit that thumbs up. Should be like right down at the bottom of the screen somewhere. I appreciate it. Helps out the stream, helps me out. And I appreciate all the likes and subscribers that I can get. All right, let's get into it. Last year was the toughest for entry-level home affordability in 4 decades. I don't think that's going to shock anyone at all, right? Like, we've known for a while that housing affordability has been difficult. It's been tough. It's been hard. It's been an uphill battle. And we know that it's been the hardest it's been for some time. Prospective buyers have reasons to be hopeful, but mortgage rates aren't among them. And it's unfortunate because mortgage rates have really bounced around. How do I get rid of this ad? I don't want to see MailChimp. Sorry, guys. I don't know how to get rid of this thing. There's no X. I don't know what the deal is. It's just one of these things that we have to look at, I guess. It's interesting because part of it is with interest rates is one of these things where they're talking about how in, November, right? October, November, we were like, oh, we're going to get another rate cut in December. Rates could be 6.5% by January. And that is certainly not what happened. In fact, they did the opposite. Of course, we had a political administration change. Whenever there's a change in political administration, it always kind of makes things, I don't want to say go crazy, but there's just a little bit of uncertainty, a little unpredictability. Doesn't matter if the incoming administration is Republican, Democrat, whatever the outgoing, that doesn't really matter. It's just the fact that there's a change. Now, we did see an interesting update that it looks like mortgage interest rates actually ticked down a little bit recently. I was going to look for the date of this article. Okay, so this is 2 days ago. And I heard today that interest rates ticked down, mortgage interest rates ticked down a little bit based on some of the stuff that President Trump has been putting out there, executive orders, things like that. So we'll have to see. Interest rates are still, we just don't know what they're going to do. We're not anticipating much movement either way. I don't think they're going to go way up. We don't think they're going to go way down. And we're just going to have to keep looking at economic data to try to make an educated guess on what's going to happen with mortgage interest rates. So here's what top real estate analyst Ivy Zelman thinks will happen in 2025. The U.S. real estate market is bound to have a better year in 2025 after historically horrible stretch for housing affordability. But those looking for major improvements may be disappointed. I've got news. It's not maybe disappointed. You will be disappointed if you're looking for major improvements. Entry-level home affordability reached a 40-year low last year, according to data compiled by Zelman and Associates, the real estate research firm led by famed analyst Ivy Zelman. I have never heard of Ivy Zelman, but I'm not the end all be all of real estate analysts, but I've never heard of her. But let's see what she has to say. 2024 was the worst year for entry-level home affordability in 4 decades, according to Zelman Associates. And here we can see a graph they put out. High rates, high prices equals stretched affordability. Well, that's not a real big surprise. That's not groundbreaking information. So you can kind of see here that they went back to, anything above this line. And this is, I don't know how they got this line. It's some type of line that they have determined denotes favorable versus stretched affordability. And you all can see that back in, what is this, 1983 probably? Oh, I didn't mean to click on that. I don't want to. Here we go. Let's go back here. So 1983 was at 143 in terms of the index. And in 2024, we were at 121. 2025, we're estimated to be slightly, though, that on par with 2023. And then in 2026, estimated were slated to be actually a little bit below 23 and 25. So trending in the correct direction. But we peaked here in 2024 with a metric at 121, which was most closest to back into 2006. And this is why a lot of people started to get this 2008 talk with affordability and prices going up. Now, those people were amateurs because they were only looking at pricing and affordability. And that's just one factor of the health of the real estate market. And that was really the only overlap between 2008 and 2022, 23, and 24 was simply the fact that prices went up. Now, the reason why prices went up is a big difference between 2023, 2022, 21, and 2008 and 9. And that's why we're not in the same predicament. But this is a really good idea where you can see that, man, we are just operating at a little bit higher level, a level akin to the mid 2000s and also the early 80s. The early 80s even worse, actually. And boy, when you look back at this stretch right here, this is what we call the good old days. We didn't know how good we had it, friends. We didn't know. I mean, look at the affordability here. I mean, of course, this affordability here is a little bit, it's on a rebound from a market crash. So this is a little of a anomaly, if you will, a little outside the norm. However, these numbers here, these figures here, I'll tell you what, talk about the good old days when we were hovering around the mid 80s in terms of the affordability index. And man, the market was normal. People were able to buy and sell homes. The volume transactionally was high. Boy, what a good time, and the stark difference and how quickly we got there. And you can start to see why there were, calls for a potential market crash from the crash bros, but it's just not the same market. Similar look, but completely different fundamentals. All right, let's continue on. Would-be home buyers were battered by exorbitant property prices and mortgage rates. And this is talking about 2024. Although both aspects of affordability improved modestly from peak levels, it wasn't enough to give home sales a meaningful jumpstart. And a lot of people in the industry thought that 2004 was going to be kind of a recovery year. Unfortunately, it was kind of the opposite. I mean, housing didn't get worse. It just didn't really get better. And now we're setting our sights on 2025. And hopefully the trend that we saw on the chart above does continue. Hey, Innovative. How you doing, buddy? Hope you're doing well. Thanks for hanging out in the stream. What do you got? Let's see. Does the affordability index take into account price? It does seem like this affordability index that we're talking in this graph, it does look like it does, because the very first thing they mentioned is higher rates, higher prices equal stretched affordability. Now, how Innovative, you asked a good question, how they calculated this, or is it just monthly payment? That's a good question. I'm glad I read the second part. I don't know if they were talking about prices or monthly payment. If I'm taking the information based on what they say, if you look at the bottom down here, we're looking at CoreLogic, Census Bureau, FHA, Freddie Mac. I think that this is probably prices. That's just an educated guess. I don't think it's just monthly payment. I think it's prices. So just based on the sources that they used and the fact that they said high prices, not high payment, but I don't know for certain. So that's my best guess on that. Younger generations who didn't already own property had it toughest. And this is something that we've heard for a while. The first-time buyers are absolutely just getting blasted. I mean, they're getting destroyed in the trenches. And that's mainly because they don't have real estate to leverage already. If you're a move-up buyer, you've got some real estate that you can leverage. Remember, real estate, one of the beauties of real estate is it typically keeps up or outpaces inflation. Inflation has been rampant. Everybody knows that. But what has been more rampant than inflation? Property values, right? So if you were a homeowner or you are a homeowner, you've had the boost in equity in property values. If you're a first-time buyer, you haven't had that. And unfortunately, you probably haven't been able to insulate yourself from inflation unless you're really good with managing your money and you're able to put it into a high-yield savings account, the stock market, or something like that. If you're just trying to save up your cash in a checking or savings account, it's going to be difficult. And that's why younger generations who don't already own property have by far the biggest uphill to climb. First-time homebuyers made up less than a quarter of purchases. Realtor.com found the lowest rate since 1981. Housing analysts are likely sick of references to the 80s, which is one of the toughest times on record for home affordability. Let's go back up to our chart to 81, which is right here. I want to get this right. Yeah. So the second highest year on record for the home affordability index, just shy of 1982 at 143. So it's no surprise that 2024 mirrored 1981 very closely, because we're in a similar spot. We're in a very, very similar spot. So not surprised to see that. The new year often brings optimism, and 2025 is no different for those hoping to buy a house. But it may be best to stay patient based on year ahead projections from Zelman and her team. Their estimates for mortgage rates, home sales, prices, and supply in a January report indicate that the year ahead will be better in many ways than 2024, though still full of headaches. Hey, at least we've got some progress, or at least some projected progress when it comes to the pundits and the analysts projecting what's going to happen. That's a good thing. We still have a long road to climb, but honestly, at this point, any relief that home buyers can get is good relief. So we'll definitely take it. And hopefully the trend continues into 26, 27, and 28. And hopefully by the time we get to 20 to 30s, we'll be looking in a better place. And kind of like, I'm going to bring up the C word. Okay, guys, I'm going to bring up the COVID word. Remember when COVID first hit in 2020 and there were some kind of projections and analysts by some professionals that, infectious disease and doctors, they said, when we do have a pandemic, it usually takes somewhere between 1.5 and 2.5 years to kind of return to normal. And that was kind of about correct, right? So in 2020, the pandemic hit and things didn't really return to normal until about 2022 or so. And when we identified the housing crisis in 21, 22, and 23, a lot of assessments were that we really wouldn't see a lot of relief for about 5 to 8 years. And the reason behind that was because the really only solution is to build more houses. And that takes a lot of time. So I wouldn't be surprised to see, I'm going to scroll back up again. I'm not surprised to see this peak kind of like pick up like this, because the housing crisis really started, here. This is when it started and it really took off. And you'll notice the affordability index shot way up in 2022 because that's when interest rates started to shoot up. So the housing crisis was already starting in this, here, now you can see the housing crisis really started in this one little area, or is when we really noticed it. It wasn't a problem because interest rates were low. So affordability wasn't a problem. It was inventory that was the problem and pricing that was the problem. And then interest rates went up and then affordability went to hell in a handbasket. And this is where we're at. So I'm not surprised to see that, we're trending on the right direction. I don't think we're going to be back down here, until somewhere in this region. And that really does put us in about 2030, which, 2022, 2030, 2021, 2030, we're looking at that 7-8 year span. So I'm hoping that by 2030, things settle down a little bit. And if we go back, and if history is any guide, we can see that a housing crunch started in about 1979. And quite honestly, we can see that the housing crunch kind of didn't alleviate until about 1987, 1988. We had a double dip recession in the 80s, which is why we see a tick back up in here with pricing. And then it started to calm down a little bit and get more favorable. So back in the 80s, it was about an 8-9 year cycle. In the 2000s, we started having a housing crisis in about 2004, 2005, with the prices going crazy. And that didn't get better until about 2010. Once again, another 5 or 6 years. So unfortunately, it's a very, very long cycle for housing to get healthy again. Fortunately, we are probably already about 40% of the way through it. So we just got to sit tight a little bit longer. Okay. Heeding Zelman's calls has historically paid off. Nearly 20 years ago, Zelman was famously skeptical about the housing market. Shortly after came the housing bubble and financial crisis. She also warned of higher home insurance costs this summer due to rising global temperatures before the devastating California fires that some observers say are climate change related. This whole paragraph is kind of whatever to me. This is kind of just some malarkey. The funny part is after the housing crisis in 2008 and after the market crash, which it was funny, nobody saw the housing crash coming. It blindsided everybody. And now all of a sudden, it seems like in the last few years, I've heard, oh, this person called the housing crash. This person called the housing crash. This person called. All of a sudden, everybody knew the housing crash was coming. It's kind of weird how that worked. Nobody knew back in 2008, but now all of a sudden in 2023, 24, and 25, a bunch of people knew it was coming. So I don't buy it. I don't buy it. And maybe she might have made some remarks that said, well, this is crazy. Prices went too high too fast. Something's going to happen, but it doesn't mean that she called the housing crash. Additionally, everybody knows that home insurance costs are going up. Even before the California fire, the LA fires and all that stuff, everybody already knew insurance was going up. It has been going up. That's nothing special. This is whatever. This is nothing. Below are 8 charts from Zelman's report showing what's next for U.S. real estate, which includes the housing and rental market. So now we're going to get to the good stuff, these actual charts. Mortgage rates stay stuck higher for longer mortgage rate trajectory. So projected annual 30-year fixed mortgage rate based on implied forward yield curve. So as of September 24, so this was like, again, back in September when we thought, hey, interest rates are coming, 2025, the rates are going to go down. We could even be flirting with 5.9% by, second or third quarter of 2025. And obviously things are different. So in September of 2024, as of September 2024, we were at 6.6% rates and they went up to 6.75. As of December 2024, we were thinking in September 2025, we were looking at 5.9%. Now we think we're going to see almost a full percent higher at 6.7%. And in 2026, back in September, we thought, hey, we could see 5.8%. And now we're hoping to see 6.5%. So these have been revised. We were hoping to see high fives in 25 and 26. And now we're hoping for mid sixes. So again, better. It's an improvement. We're heading in the right direction, but it's not quite as good as we thought. I will say that take this all with a grain of salt because President Trump has some ideas. He's got some plans. We'll have to see how many of those plans actually get implemented, how many of them get implemented the way he wants them to versus a watered down version, and how many of those things don't get implemented. So, and a lot of those economic policies could definitely have an effect on mortgage interest rates. So take all this with a grain of salt. Predicting interest rates is extremely, extremely difficult, and it's almost kind of not worth even doing because there's just so much unknown. Hey, David. All right, let's see. What do you got for me? Where were the home appreciation bros in 2020? Why didn't they predict a home price appreciation in 2020? You're exactly right, David. If they're so good, if they know the market so well, if they're so in tune with what's going on, how come they all said that there was going to be crashes and the sky was going to fall and the bottom was going to fall out and we were all going to be poor? Why didn't they predict the opposite? Why didn't they predict a huge growth in home prices and huge gains in appreciation? Maybe it has something to do with the doom clicks and what we call doom porn and doom scrolling and the fact that people are always consumed with the bad news over the good news and maybe the whole clickbait thing. What do you think, David? Let me know what your thoughts are. Why do you think the crash bros didn't turn into home appreciation bros? I would love to know what you think, brother. All right, let's go to the next chart. Many of last year's upbeat predictions about the housing market, including from Zelman, centered around declining mortgage rates, like we talked about. The 30-year fixed rate had tumbled from 7.8% in late October to 6.6% by New Year's. And analysts said it would fall further as interest rates dropped. I remember October, 6.6%. By New Year's, we're looking at like 6.3%. 2025 is good. We're going to light the bottle rocket. This thing's going to take off. And unfortunately, that didn't happen. Rates that, oh, you guys don't have the article up. Haha, there we go. Rates then reversed higher through April to 7.2%, which was a major surprise for Zelman. The unexpected jump in borrowing costs postponed sales, though it looked like a blip once rates trended lower through the summer and into the early fall. But in the last 4 months, rates have steadily risen back to slightly restrictive levels. The U.S. economy is even healthier than expected, and investors think President-elect Trump will usher in even stronger growth and potentially higher inflation. And this is This right here, these 2, 4, 6, 7 words. This is why our affordability levels are difficult. This is why the affordability index is so high right now. It's because the US economy continues to just turn and burn. A lot of people continue to work. Again, bringing up the crash bros, all these crash bros were like, oh, the layoffs are coming, the foreclosures are coming, the tech layoffs. Yes, there were some tech layoffs, but not a lot, not enough to really make a difference. And the U.S. economy just continues to roar. And when the economy does well, interest rates have to stay high. That's just the way that it works. Because if we were to lower interest rates, the money would be cheaper. Businesses could take out loans. They could hire more employees. They could launch new product lines. They can expand storefronts, and they can generate more money. When they generate more money, they can pay their employees more, and then people spend more. So we don't want the economy to tank. We don't want the economy to have a major setback, but we could use the U.S. economy to slow down and remain stable a little bit instead of continuing to just go crazy. All right, David, let's see what your take is. Maybe the home price appreciation bros were too busy buying homes and didn't have time to create content. Yeah, maybe that is the problem, right? Maybe they were too busy doing the opposite of what they told their subscribers to do, which could be a potential, right? Man, think about how many people lost out on how much money by listening to Crash Bros between 2020 and 2023. I don't even want to think, or even to today. Man, I feel bad for some of those subscribers that listen to those guys, because as we can see in the chart, it's only gotten harder to buy a home. Either way, markets are counting on higher for longer rates, as is Zelman. She thinks rates will be roughly flat this year and sees the 30-year hovering around 6.7% before slipping to 6.5% in 2026. That means buyers shouldn't hold their breath for lower borrowing costs. So here you go, buyers. And I agree. I think she's right. I think Zelman's correct. Obviously, she's got a good track record. She knows real estate. She knows the market. I don't think there's going to be a meaningful discount in interest rates. So if you are a buyer and you are thinking about, potentially purchasing a home, and you're thinking to yourself, you know what, I want to wait to see what rates do. There's very likely going to be very little change up or down in interest rates over the course of the next year. So moral of the story is if you've got that down payment, if you are comfortable affording the payment for the home price point that you're looking in, if you find the home that you like, if your job is stable, if everything looks good, then you should absolutely buy a home if one comes up that fits all of your needs, because chances are it's not going to get any more affordable, both in price and also in the mortgage rate. 2, home sales March higher. Still expect growth in new home sales. That's NHS, new home sales. So brand new homes, but outlook lowered. So you can see new home sales. This is the chart. New home sales in thousands. So 831,000 in 2020. Tapered off a little bit in 21 and 22 because, again, nobody knew what was really going to happen. And then we've stepped it up a little bit. So these numbers in yellow are all projections. These are estimates. So we are still going to see an increase in new home sales, but it's going to be pretty stepped, like what we've seen in the past. It's not going to be crazy. It's not going to be like from 2019 to 2020 or anything like that. So elevated mortgage rates are a deal breaker for many buyers and unacceptable for others. About 3/4 of current owners have mortgage rates below 5%, Zelman's firm found, and over half, 56%, are locked into rates lower than 4%. It's no wonder why they're reluctant to swap that rock bottom rate for a 7% mortgage. So there you have it. This is the lock-in effect that we've talked so much about. However, those who need to move may decide they can't wait any longer, given that rates may stay near current levels for years, which is true. If you get transferred for your job If you have another child, if you get married, if you have 2 more kids, if you get divorced, if someone passes away, there's all sorts of things that lead to the need for someone to move and either buy or sell a house. And that will always happen. Both new and existing home sales should rise about 5% next year in a healthy economy. In Zelman's view, a year ago and last April, she thought sales would surge 8% in 2025, which reflects how higher than anticipated rates are weighing on demand. Here's an interesting one. Existing home prices rise at a modest pace. This is a little bit of relief for home buyers out there. Change in year-end existing home price index. All right, pop quiz. Who can spot the real estate crash on this chart? Anyone? Where do we think the real estate crash might be? Yeah, it's very quite obviously this red area, right? Like this is the great financial crash, the real estate meltdown of 2008 and the surrounding years. But we're not looking at that right now. We are looking at this. So this right here was 2022. This really, really tall bar is 2022. We can see we shot up, started to shoot up. 2020 was kind of the calm before the storm. I'm having a hard time figuring out which is, got to put a little ruler on my screen here. Okay, so 2019 here. 2019 right here. It started, it was pretty level 2018, 2019, shot up in 2020, shot way up in 2021. That's when interest rates were still low, inventory was tight, and bidding wars were going insane. 2021 was the wildest year in real estate I've ever participated in, and I've been in real estate since 2013. And as we can see, this is a change in year-end home pricing. So home pricing went up over 15%. From the previous year before. So this is a big change. This is a huge increase in pricing. You can see there was in 2023 only a 5.8% increase. And guess what? In 24, they're predicting that it would have been 3.9%. In 2025, they're estimating 2.9%. In 2026, 3.3%. So this is much more normal. This is much more predictable. So it is below average home price appreciation. We're still going to see appreciation in home prices, but we're not going to see these record numbers. Homeowners are already reluctant to move, so it stands to reason that they'll hold out for higher prices. Properties already on the market should sell for about 3% more than last year, according to Zelman and Associates, though that's below last year's rate and the expected figure for 2026. New home prices inch up. Again, so this is for brand new home sales. We can see that in 2020 and 2021, home prices, new home sale prices, way up, especially previously over the last couple of years. And now we're seeing in 2024, they're estimated to be a 0%, 1% in 2025, and 2% into 2026. A glut of new homes entering the market will keep prices at bay, Zelman and her team say. And of course, there's a glut of new homes because we've been trying to build a ton of new homes so that we can alleviate these crazy prices and get more people affordable housing. They expect freshly made properties to sell for 1% more than in 2024, following a year of flat prices. Single-family rent growth stays in check. And again, we are basically looking at the trend. Boom. Single-family rent bumped way up. Economic single-family rent growth. So lots of rent growth here, and it went way up. And now we're seeing that growth is going to return to actually below normal. So rents shouldn't continue to increase nearly at the pace that they were increasing back in 21, 22, and 23. On the rental side, Zelman thinks landlords will still score price hikes, though at much lower rates than in the mid and post-pandemic boom. Rent growth should fall below 3% for single-family units for the first time in a decade, as rising inventory means that the occupancy rate isn't nearly as stretched as it was a few years ago. Multifamily rent growth remains below trend. So again, similar thing. This is for multifamily. So this would be for like your apartments, your large apartment complexes, things like that. rent is projected to go up, but at a much slower and more normal pace, and actually below the average of 2011 to 2019. Rent hikes will trail wages gain. So this is the basis point variance between single family blended rent growth and wage growth. So we can see the difference between rent growth and wage growth that gap is going to close up. That means that more people should be able to afford the rents. The silver lining for renters is that these increases shouldn't break the bank. Wage growth outpaced rent growth last year for the first time since at least the mid-2010s, according to Zelman and Associates, and the trend should continue this year into 2026, which is obviously very good. Multifamily supply growth slows but stays strong. So again, multifamily, that's your large, large apartment complexes, large rental communities. And you can see here we are in 2024, and we've got some improvement, right? We've gotten some improvement. 2025 estimated here, and 2023 estimated here. So we're trending in the correct direction. So just kind of some interesting stuff, from someone who is a bubble watcher and obviously a pretty in tune analyst. Some interesting charts that kind of sum things up, and obviously there's a lot to take away here. Some of these charts, well, really pretty much all of these charts convey some type of improvement in the real estate affordability space. Now, is it going to be the type of improvement that a lot of buyers and renters want to see? Unfortunately, no. But like I said, any improvement is really good improvement. All right, I'm going to switch this over. I've got a little 4-minute video clip that we're going to take a look at. And again, this is from, I think, The Squawk on CNBC. And this is this Ivy Zelman. She's not talking about the article we just went over, but she's talking about some of the other things. And this video is only about, I think, 3 weeks old. So it's pretty relevant, pretty recent. Let's dive on in and see what they have to say.
In 2024, housing remains a key issue heading into the new year. Consumers will continue to try to navigate both of these things. High mortgage rates, though, and high prices. I want to bring in our next guest to discuss what to expect in the new year. Ivy Zelman, Executive Vice President, Zelman and Associates. Good morning, Ivy.
Good morning.
What do you think is going to happen? I mean, did you see there's a story, by the way, in the Journal, is it this morning, that says that your mortgage is not actually even your biggest cost anymore? Did you see that? It was actually surprising.
No, I did.
Surprising statistic.
Like 32% were paying more than half of their mortgage payment to property taxes and homeowners insurance.
And we talked about that, and that's pretty crazy. So based on the thing they saw, 32% of people, your mortgage, that's the bill you get in the mail, and that's what you have to pay. Your mortgage consists of usually property taxes, insurance, sometimes HOA, usually not though. Your principal, which is the actual loan, what you pay the bank, and interest, which is also going to the bank. And of all of those things, more than half of that payment was made up of just insurance and property taxes. That's a real problem. And that could be the next crisis that we see, aside from the affordability and pricing crisis and inventory crisis. We're going to start to see people get into homes and then realize, whoa, this is really, really, really expensive. And taxes and insurance are only going to continue to go up, especially depending on where you live. So that could be a problem definitely in the future. All right, Innovative, let's see what you got for me. So flat-ish prices in 2025. Is that the main takeaway? Asking for a due, trying to save as much as you can before prices jump again. Yeah, basically, Innovative, you've heard that right. It seems like interest rates are going to basically be flat with maybe a little bit of relief moving into 2025 and into 26, but negligible differences. And it seems like home appreciation growth is going to slow down closer to that 1% to 2%. Now, keep in mind, you're a smart guy. We've talked a little bit before. This is location dependent, right? I believe you are in the greater Dallas area, if my memory serves me correctly. So it could be a little bit different for you, but this is just a national trend. So it looks like home price growth isn't going to be insane. It doesn't look like Home prices are going to go way, 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 way up. But again, it's very market dependent. And I'll leave you with this little tidbit. I just put a listing on the market on Wednesday. It's a 3-bed, 2-bath patio home, basically like a single family attached home. It shares one wall. It's 1,750 square feet, very pleasant, good schools, good city, good location. It's a good home. And in my area, it's affordable. We got 5 offers on the property, and it's very likely that it's going to sell for at least, I don't know yet because it hasn't gone into escrow yet, but it's going to sell for over the asking price by at minimum of $25,000 or $30,000. So, I think it really just depends on where you are, but nationally as an average, it looks like it's going to be a lot more stable in 25 and 26. So a little bit of help for you. Let's see, David, that is crazy. That will also trickle down to renters. Renters will pay for the increase in taxes and insurance. It absolutely will. And that's one of the fallacies, and I'm sure, David, you've got this too, when you're talking to renters and stuff, renters go, oh, well, I don't have to pay taxes and insurance. Like, it's so great being a renter. And the very first thing we tell them is nope, you're wrong. You are paying taxes and insurance. You just don't know how much you're paying because it's wrapped into your rent. So yeah, you're exactly right. It's going to hit everyone. It's going to hit everyone. Thank you, good sir. I appreciate it. It's been a very, very, very busy week. It's been a very busy January. Got a couple closings coming up this week, and thankfully blessed to be busy this time of year. So thank you on the congratulations. Appreciate that very much, David. All right, let's get back to it.
Troubling.
Pretty troubling. So what do you, as it portends for 25, what do you see?
I think more challenges. We haven't seen any relief on the stretched affordability issue, and that's only getting worse as mortgage rates remain elevated and are going higher.
What do you think the rates will be for the next 12 months? What do you think like the average homeowner should expect?
I love this. I love when dudes like this, put their guests on the spot and they go, what do you think rates are going to be? Nobody freaking knows. You could ask Jerome Powell. He wouldn't even know. He's in charge of the rates and he wouldn't even know. And I love her response to this because clearly she's gotten this before and she just comes right out and is like, bro, you're asking the wrong person.
They were going to go try to buy a new home.
I don't forecast rates, but I can't imagine why rates would go much lower from.
The first thing is I don't forecast rates. Everybody wants I got to be, I'm not going to touch that with a 10-foot pole. I don't want to be on the hook for saying something incorrect or something that I don't know. So, and I agree. I would have said the same exact thing. I would have said, I don't know what rates are going to do, but it seems like there's not going to be a whole lot of movement. And that I think, I do agree with her on that.
Here, especially with some of the Trump administration.
Just as a side note, I don't know if there's any females in the chat this evening. Maybe my wife is, maybe she's not. Maybe my mom is, maybe she's not. I don't know. The face on this lady, she is she's got like a porcelain doll face. She is like the smoothest. I wonder how much money is in this face of hers between Botox and other work. She is just very, very smooth, very slick. Yikes. All right, let's continue. Enough with my side notes.
Administration proposals with potential risk of higher inflation. So I think that right now we're looking at the affordability index is probably about almost 25% above trend line for existing homes and about 10 to 15% above for new homes. So I think today it's really troubling for the entry level buyer. We are seeing more resilience for the higher move up segment, especially those that are able to use cash, but it's a challenging market.
Yep. And that's basically what we've heard for a while. We all kind of knew that. First time buyers kind of screwed. If you've got some equity that you can exchange, much, much better off. And ultimately, things are still unaffordable.
In terms of new builds, when you look geographically, is there any market where you see actually something really great happening?
I wouldn't say there's anything great happening, because if you look at the markets that are not high production new home markets, like the Midwest, we're actually seeing continued home price inflation that's pretty significant. Take my home state of Cleveland right now, or my market of Cleveland right now, home prices are up 8% year to date, compared to markets nationally up 3 to 4%. So I think where the production builders are, that's making availability of more product more competitive and keeping a lid on home price inflation. But I wouldn't say anything's really good going on. And I think that we're definitely see that bifurcation in the market throughout the U.S.
Do you like any of the home?
All right, so I see David's got something. Dave, what do you got for me? Let's see. Joe, in your market with the fires, has that had an increase in buyer demand, or are we way too early to assess? David, you make a good point. I'm going to switch away from this for a second. I would say that, yeah, we're already starting to see some activity because of the fires. My brokerage had, well, actually my broker had a listing in my town. It was very pleasant, 4-bed, 2-bath home. And the buyer that bought that was displaced by the fire. We've had a lot more renters coming our way, though, not as many buyers. I think obviously for buyers, it's a little bit more difficult because I don't know how many people can have their home burned down and they can just run out and like buy another home. Which means, obviously they have to have a lot of cash saved up. They have to have good income to be able to just, go buy a home before insurance is paid out or done anything. So I think that is coming, but it's a little too early for that. We've been seeing an increase in renters, definitely. I did hear about a lady who submitted an offer on a listing in my town, and she was living in South Pasadena in her rental, and she was told that she had to leave. She was given her 60-day notice because the owner of that rental had children that lost their home in the fire. And so the kids were going to move back to that home. So the landlord had to serve notice to get his tenant out. So she was not a victim of the fires, but she was kind of indirectly displaced by the fires. So, and I think that's only going to increase. I think that's only going to increase. I think we'll know a lot more come April, May, and June. And I think that in my market, I do believe that this spring and summer could be even more active because of some of the people that decide, I'm not going to rebuild in Altadena. I don't want to be in that area anymore, or I can't afford to be in that area anymore. I've got paid out from insurance. I've got some money. So I want to buy a little house where it's much more affordable. And comparatively out here where I am, about 30 miles east of Altadena, it is much more affordable for your average person in comparison to Altadena. So could definitely see that. All right, back on with our show.
Home builders, the public home builders, publicly traded home builders.
We are
Publicly traded home builders.
Let me go back a little bit.
Do you like any of the home builders, the public home builders, publicly traded home builders?
We are more skewed to the high-end builders. We're recommending builders like Toll, Dream Finders, Taylor Morrison, but we also like Lennar, given the transformation we're expecting from the spin, the Milrose spin. But I think it's all relative. I think we're more neutral on the sector, given the challenges that we see. We think you have to really be looking for, some modest exposure, but there's no question there are headwinds. And you start talking about the risk of tariffs and, deportation. I think there are headwinds that will keep the sector a lid on performance.
So you actually you're saying you would not even buy in?
Yeah, I agree. I think she's right. I think that with Trump's tariff stuff and the deportation, there's probably, I think the home builder, when it comes to their stock pricing and their values, are probably going to sit tight because they're kind of in an uncertain situation themselves.
Well,
if you were not exposed.
Yeah, I think that you want to have some exposure, but relative to the market, we don't see the sector outperforming the market.
But you go high end over something else. We're looking at the Spider S&P home builders. You wouldn't want to buy an index of this. You'd be more particular.
Yes, I'd be more particular. I think you'll see whether it's the entry-level builders will have a tougher time. The incentives, we just did our proprietary survey, we released it. Incentives that are 2-year high. Spec inventory is also pretty high, but they're working through it. So I think that we're going to see margin pressure. I think that will be less evident for the builders that are more skewed to the high end. So it's challenging. The builders are,
which is not surprising, and it's unfortunate, right? The high end builders will be okay, and unfortunately, we know this, right? Because we've seen this before already. Why don't home builders build small, basic, straightforward homes? It's because the cost to build a small, basic home is not that much less than to build a big, luxurious home. But you can sell a big, luxurious home for much more than you can sell a small, simple home. So I think that, kind of what Ms. Zelman is getting at is the fact that, hey, those luxury high-end builders, they're going to continue to build, and they're going to continue to be able to sell those homes to people that want to upgrade, that want to sell their smaller or mid-sized home and get into something bigger or larger or more luxurious. And those companies will continue to do okay. Whereas the companies that maybe build your more affordable entry-level homes, well, we know that the entry-level buyer is getting smashed right now. They're just getting destroyed. So it does make sense that those sort of builders that cater to entry-level, more plain, more simple homes are going to have a harder time when it comes to profitability and stock price and just overall company health in comparison to the, obviously the more luxurious builders.
they're very well positioned. Their balance sheets are the best they've ever been. But nevertheless, as we sit today, I don't really see an exciting catalyst that would propel these stocks as an industry, as a group higher.
Yeah, so that makes a lot of sense. Obviously, she's pretty smart. She knows what she's doing, and I agree with a lot of her points. A lot of analysts I disagree with a lot of times, but not her. So just kind of interesting. Okay, guys, we are at 51 minutes. I told you that we were going to kind of virtually look at some properties, and I was going to give you guys sort of my 2 cents on how to look at properties. Unfortunately, I don't think we're gonna have enough time for that, so I'm probably going to save that for next week. I'll probably do a similar thing where we'll find another article, we'll talk about it. I didn't think I was going to talk this long on this one, but we went a little bit longer than I thought. And then the second half of the stream, I'll show you guys how I evaluate properties when I'm looking for clients, and kind of what you can look out for either red flags or even some green flags when you were talking about looking at a property strictly online, right? So things to look for when you're trying to see if a property is worth looking at in person, or pursuing. So guys, with that being said, thanks so much for hanging out with me for the last 52 minutes. You guys have been awesome. David, innovative. Thanks for chatting. Thanks for keeping me company. I very much appreciate it. We'll be back again next Wednesday. Of course, same time, same place, 6:30 right here on the channel. If you guys haven't liked or subscribed to the stream, please go ahead and hit that subscribe button, hit the like button. Really helps me out quite a bit. Thanks so much for hanging out. I hope you guys have a wonderful rest of your week. If you're in the greater LA area or now Santa Clarita, there's a new fire that popped up. Please be safe. A lot of the LA fires are contained. They're mostly contained or they're out, but people still need a ton of help. So please, if you're still able to donate monetarily or with goods, please do so. If you need help donating, shoot me an email, shoot me a DM. I would be happy to help you donate to a great cause that is the recovery from the LA fires. So everybody have a wonderful Wednesday evening. I'll see you all next week. Have a good one. Stay safe out there. Bye.